Good day to all. This will be the second part of our discussions involving the goals of organization or corporations in corporate governance. So we will begin as to who is the financial manager. We are going to discuss about the chief financial officer. So the CFO of the organization or corporation is treasurer or controller. To summarize and differentiate the two, normally the treasurer is focused on the financial management aspects, all about maintaining and securing the cash position of the organization as well as the safeguarding of the assets. While the controller normally is focused on the financial accounting and reporting side. So preparation of the financial statements, budgeting, and taxation. And we can see such here on the next slide about the CFO's function, supervises all financial functions and sets overall financial strategy. Now, normally the CFO is the vice president of the finance department. And some are asking, which is greater on that extent, the finance or accounting? Normally, the accounting is also part of the finance function or department, but I've known that some would be separating the two, but overall the two would be under the chief financial officer. Some books would be using, or some sources or companies would have VP finance or vice president finance, similar to that. Or even the VP accounting would be the similar sense or thing. So depending on how the organization would be delineating or would be showing the functions of such person or position. Then we have the treasurer that is responsible or who is responsible for financing. Again, all about the cash position management and relationships with banks and other financial institutions focused with financing and the sources of such. Controller, on another hand, we've explained budgeting, accounting, and taxes or taxation. Now, for the functions of financial manager, let's look into these particular diagram. So we have items 1 to 4B. For number 1, monies coming from investors will be managed by the financial manager. And in such management, such monies will be used or utilized in the firm's operations. In return, such firm's operations would involve the respective generation of cash that can be invested further in, let's say, more assets of the company. All the real assets could already be there, present as part of investment, and can be utilized to produce more assets then. Next to that, if the real assets are utilized in the firm's operations, so to be gathered for cash wise of the financial manager and will be reinvested. So if that is reinvestment, so that will be managed by the financial manager once again, hence the arrow or the flow of the arrow from the 3 to 4A. And some cash, if not all, would be returned to investors. So these are now the financial assets as we speak of. So financial assets will be the income, of course, claims to those when goods and services have already been rendered. So we can see the flow here, or the respective diagram shows to us how would the respective cash flow from investors to the manager to the operations back to the financial manager and going back to financial assets on the part of the investors. So basically that's the flow that we can check about and would help us understand how this flows again. So another one area that we can look into would be the goals of the corporation. We have to take note that shareholders desire wealth maximization, and this should be the focus of financial manager, or any financial manager should think of this particular wealth maximization. So first priority of financial managers. How will wealth be maximized? Normally, the evidence would be the share or stock prices, wherein the values of the shares would really increase. So that's the point where we can see that, oh, there is maximization of wealth. Now, let's differentiate it with profit maximization, which is the focus, the main objective in financial accounting and reporting. For a business to have or gain profits, maximize profits, and which year's profits. However, we have to take note that earnings can be manipulated. So there can be the so-called creative accounting in which the records can be manipulated in order to produce certain earnings. And with that, there can be a concern. Anyway, profit maximization is just focused on historical earnings, but wealth will be focused on certain accumulation of those profits as well as the management of the organization that will be carried forward from this point in time forward. So the evidence again would be the share prices, because whatever experiences that there are throughout the years will be accumulated into the share price. So that would be the reflection of all things that happened from past to present. For opportunity cost of capital, opportunity cost is the benefit foregone should we select one option to the other. As explained here, the minimum acceptable rate of return on capital investment that is set by the investment opportunities available to shareholders in financial markets. So if we select, let's say, out of three options, option A, then the benefit foregone should we use or choose A coming from B and C and or, then that's the opportunity cost. But let's limit with two options. So whatever will be the rate of return on the capital investment set by the investment opportunities, like we use A versus B, B will be the opportunity cost. Here is the trade-off though for the investment. Trade-off would show to us that basically if we can have cash and we place that in the firm or invest, the firm as represented by the financial manager would invest such to real asset, because these assets can produce goods or services that would generate income for the company and can be translated into claims and back to cash. So firm will invest such, and then firm will pay out to shareholders in the form of dividends. Shareholders will invest such more. Shareholders invest for themselves. They have their investment opportunities in the form of financial assets wherein they can gain. Again, if they invest in debt, so they can gain the principal plus interest. If they invest in equity, they can gain out of the dividends plus the capital gains, the increase of values of shares. So basically, this was the flow also a while ago. You can see that here. And if we go back, so investor side, which we have not tackled that deeply. So financial assets, because they're going to use the monies they have received. All right. Agency problem can happen when the personal interest of the managers would go in the way or would block or would prevent the achievement or fulfillment of the corporate goals or objectives. Here's a question. Do managers maximize shareholder wealth or manager wealth? Supposedly, it's shareholders' wealth because that's the main objective. Please take note that without the shareholders, there wouldn't be corporations, and they're placing their money so that they can earn their returns in the form of dividends. So they should be the main priority. Managers, though, have many constituencies called stakeholders, and stakeholders would be people with financial interest in the corporation. So you think of certain benefits that they can have should they contact themselves with and do business with the corporation. And stakeholder can be anyone or anybody, even the employees, even the regulatory agencies and the government, even the public. So agency problem can really happen if stockholders' interest would be come inferior with the objectives of the managers, who are supposedly the agents of stockholders. They are tempted to act in their own interests rather than maximizing shareholders' value. And the cost or the value of that particular problem is the agency cost. Value lost from agency problems or from the cost of mitigating or minimizing agency problems. Well, there are ways of minimizing such. This is also a discussion in financial management, actually, or in financial management courses. One way of that is to ensure or make sure that the compensation of the managers would be partially fixed and partially based on the performances that they've made. The issue or concern, though, is that how do we know that such metric or basis is reliable, that the performance really is done reliably or accordingly. So that could be an issue, but all other things being equal, so that's the concept that perhaps a portion or a bigger portion of the benefits to be received by these managers would be based on their performances. And the ways of managing the corporation would be the corporate governance, the laws, the regulations, institutions, and corporate practices that protect the shareholders and other investors. Overall, whatever laws, regulations, institutions, and practices there are, the ultimate goal is to protect the shareholders and other investors to maximize shareholders' wealth. Then let's check this one, ownership versus management. This is interesting. Shareholders versus the managers. There would be difference in information. The ownership would be looking into the stock prices. Stock prices again would summarize all experiences there are of the company or business. Management would be seeing the returns. Dilution of ownership. So it's possible that the value of our respective shares, especially the earnings, would be lowering down because of many shares. Dividend policy, that's very important. How, why, what are the means of the issuance of the dividends? Then financing decisions or sources of our financing, whether debt or equity. There can be different objectives also with the two parties. Then we can also look into managers, top versus the lower. Their interests could be different with each other. They're not going to perform supposedly their respective responsibilities as holding positions, and stockholders versus banks and lenders. What would be the elements of good corporate governance? First, legal requirements. There should be basis on the laws. There should be the managers or overall managers, the BODs or board of directors, activist shareholders. Shareholders are involved in a way or in a sense of management of the business. Again, as said, they can be officers of the organization. They can also be literally members of the board of directors. Takeovers should also be taken into account because we cannot presume that somebody will buy the corporation in a way that would be friendly to all. It could be hostile in nature. And information that is provided for investors. For maximizing the value, ethically speaking, this is a nice saying that we can actually think of. Hopefully, you're able to read this particular section from Adam Smith in 1776, and we can read this silently, or in this case, I'll be reading it. It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest. We address ourselves not to their humanity, but to their self-love, and never talk to them of our own necessities, but of their advantages. This simply means that if we have workers, then they are doing such for the sake of the job. And that's the point that we are able to enjoy whatever outputs or outcomes or products that they have had. And those are their advantages, not necessarily because of something that we get from them. They are doing such because those are the advantages on their end. not necessarily on us, but we will be benefited by that. That's the ethics of maximizing the value. This is an interesting saying. Next, another point is that, does value maximization justify an ethical behavior? So just because we want things to happen, just because the workers would like to achieve their goals and objectives, so they're now going to enter into or employ an ethical behavior. Here we can see certain terms or people mentioned that we can say resulted or actually made some adjustments in the business world, since they actually had created or made some scandals before. Example would be the Volkswagen involving their scandal with the emission tests that they've had and the emissions that they've made with the environment that violated with the Clean Air Act. So in other words, there's the law, Clean Air Act, and they violated with such and resulted to penalties. Now, for as long as we are not providing the truth, the honest and the accurate and transparent information, we can never be ethical. For as long as we're hiding something, even if that's a white lie, that's unethical, to be honest. So it's not that easy to be ethical. Charles Ponzi, on another hand, is from the 1920s. So this is the person who is known for making the Ponzi scheme, in which the scheme is that in order to show to people that the business is legitimate, so there would be payouts. However, the payouts are actually being obtained from the investments of the latter investors, so that the older investors would be enjoying more because they will be receiving first. There is legitimacy on that sense because there is, again, payout that is given. And in fact, there could be some products that are created as well so as to make the business legitimate. And then there would also be registration in the Securities and Exchange Commission. And that's how they're able to get out of the liabilities initially. But we know that the bubble could burst anytime, but not that soon. It was actually made or later on. And that's why a lot of people sacrificed in the process. And in fact, the giving of the payments would take much time. Just like the example of Bernard Madoff, in which he actually applied the Ponzi scheme in a much larger scale, but in that regard on the late 1900s to 2000s. So obtaining public trust, acting as a liable person, making a legitimate business, not showing unnecessary and exorbitant amount of returns. So the values of those are appealing to be legitimate and okay, so that people would be thinking that, oh, this is a legitimate business, so that's why they're placing more money, only to find out that it's also a Ponzi scheme. And that's the reason that these are basically not just unethical, but really major unethical behaviors and corporate scandals that shocked the world. And that's why people panicked. But of course, the government regulatory agencies created ways of countering such dramatic impact to the business world and environment. And then, anyway, does value maximization justify an ethical behavior? Let's answer that question. It does not. If you are going to ask me now, it does not. For as long as, again, we're hiding information, even if we maximize the value, that's supposedly a big no-no. Is it ethical? Short selling, wherein a certain person would be borrowing certain shares or stocks from people or individuals, and then will be selling such in the short term and would be buying back such when the values of the shares would lower down. So in other words, if that's the case, they're going to actually benefit in the process because they can get the difference as their profit. When they get that back, the value of the shares is, let's say, at $50, and then that $50, let's say, lower down later on to $40. So when they buy that back, it's now at $40, and they will return such shares to the owner, thereby profiteering $10 in the process. That's short selling. So is it ethical? No, because we're hiding the information. How can we achieve that? If we tell the owner, normally the owner would not be really interested about that unless we know that person that much. But that's how people can circumvent certain things. On another hand, corporate traders would be buying certain stocks and businesses with shares or stocks that are undervalued, and they know such. So undervaluation can happen if the real value of the shares really are much higher than what they are at the current. So the current values are not what they should be. They are actually, the current values are much lower. So in that case, the corporate traders can benefit in the process, especially if they are going to sell such with the correct or accurate values. Well, tax avoidance, of course, is the legal way of minimizing the tax. But is it ethical? The answer is no, because again, we are not declaring the correct values of income as it is. Tax avoidance, though, that's legal. It's different from tax evasion, which is really the fraudulent reporting of the tax return so that the tax income and the taxable income, and of course the taxes to be paid or the tax dues and payable would be lower. So that's another area or thing. Evasion. Clearly, evasion is both illegal and unethical. While for the tax avoidance, that is still a question because it is legal, but is it ethical? The answer is no, because there is again hidden information. It's not truth, it's not honest, or there's no really complete honesty, complete transparency, and being true. Then after this will be the questions that we can ask as preview of coming attractions. First would be, how do I calculate the value of a stream of future cash flows? This is a discussion in time value of money. How do I measure risk? That's a discussion in risk management. Where does financing come from? Discussed or to be discussed further in sources of financing, whether that's long-term or short-term. How do I ensure that the firm's financial decisions add up to a sensible whole? So that will be tackled on different investment decisions, topics, or chapters. What about some of those other responsibilities of the financial manager that we mentioned earlier or that you mentioned earlier? So will be tackled as well, respectively, on other topics. And these are certain items on snippets of financial history. In terms of changes of finance, actually there are dramatic changes from certain point in time up to the current time. So we can just check the date and the activity. So a known date for compound growth or interest or the effects of compounding. And we can see here the flow of information from that point in time onwards. So interestingly, even at BC, or we can just say before Common Era. Common Era is an established time that is common for all beliefs and religions. But then BC could be before Christ, so before Christ was basically born. But we will move beyond that religious aspect to be reliable and to be, of course, objective as much as possible. Interest rates, operations, international banking, those are terms that we know already. So banking that are, or operations that are done for banking in international scale. Futures would be basically if there is an active market, for example, for stocks or for shares, but we've already had commodity futures market. This is though in other countries' markets. In the Philippines, we just have our stock market, but that's futures because there's really a public market for the shares or stocks. Next would be stock corporations. We know this. Currency, Speculation, if there would be investment opportunities beneficial to us, especially for new issuances. Then NYSE, that's the New York Stock Exchange. In 1929, the stock market crashed. There's the euro dollar market in the 1960. Corporation became bankrupt. So there are scandals that happened resulting to bankruptcies, financial futures. So not just the stocks that we know of and the commodities are now present, plus the others, even options. So right, but not an obligation to either buy or sell stocks, for example, and other commodities. Capital investment decisions, here we go, we have mentioned that, that's 1986. Mergers, combinations of businesses, one will die, the other would still remain. Inflation, the continuous rising of prices and general level of prices of basic commodities. Then securities, also we control the risk, the euro as the currency in the European Union. Financial scandals in 2002. Problem about this one, the recent recession, especially for the Lehman Brothers, and then the subprime mortgages that resulted to recession in US because when the bubble burst, when we say the bubble burst in finance, meaning to say that when the positive or the perceived positive aspects actually revealed later on to be negative. So that's why the beautiful bubble bursted or burst. So in that case, we are actually going to experience now the negative side. And that is because of the mortgages that are actually being used as the financial instruments in order to get a loan from others. Example, let's say for us to be able to get a certain loan for real properties, so we mortgage, let's say, our very own houses, and that resulted to a certain collateralized debt obligation. So the mortgaged house is now also used as a collateral for another loan, and so on and so forth. So resulting to confusion in the public. And then in 2011, sovereign debt defaults. So that's actually, or this is an obligation or debt of a certain country, a sovereign or state. And then this is coming from another country or a private institution in a certain country or a private institution from another country. It could be the government of another country lending money to a certain sovereign. And in this case, sovereign debt defaults, failure to pay such financial obligations. So these are some snippets of financial history. And that's the end for second part. So hopefully you got something from this particular session. Thank you very much, and God bless us all always. Stay tuned for the next videos that will be released here. Thank you.